Good morning, everyone. Welcome to the December 2025 Clear Vista Financial Perspectives podcast. I'm Mark Trice, and I appreciate you taking some time today to join me for our monthly market update. It's going to be a little bit of a light day, but because of all the government shutdown data delaying everything by a couple of months, but we're going to get into some data with what we have. We're always keeping an eye on what's happening in the markets, the economy. We'll walk you through what all this means for you and your portfolio. So let's jump right in. Today, we're going to discuss performances for the indexes. We'll give you a little bit of an economic update and kind of make you aware of some meetings that are coming up in the next coming few weeks. And we'll talk a little bit about the impact it might have on your performance of your portfolio. So we like to interact with folks live during this webinar. If you got questions, go ahead and get them in. Like I said, this is going to be a little bit shorter broadcast than normal. And you can send those questions to 254-282-0495, or you can email them to info@clearvistafinancial.com, and we'll answer them the best we can during this program. And if we don't get to it, we will certainly respond back to you within 24 hours. So thanks again for joining us. Let's go into the market recap. Okay, I need to put on my little glasses for this part of the presentation. So a lot of volatility in November, and that's somewhat unusual this time of year if we go back historically and look at past performance and things like that. We saw certain indexes go down 7-8%. And that seemed like it was really volatile. A lot of that had to do with the reporting from some of the tech companies. Some of it had to do with the government being shut down still, lots of different scenarios there. But basically, everything kind of worked itself out throughout the end of the month. The S&P 500 was basically flat, up just a 0.1%. The NASDAQ, which is typically more volatile, has more of those artificial intelligence companies in that index. It was down about 1.51%. The big concern there is really with artificial intelligence is mainly that people are concerned that those companies are overvalued, that perhaps there's a bubble there amongst artificial intelligence companies. We've talked about on past podcasts about how a handful of artificial intelligence companies are making up the bulk of the market movement this year. And that's always a concern, especially when you see valuations so askew. The Russell Index was quite volatile this month. At one time, I think it was down 10% during mid-month, but it ended up the last few days of the month up 1%. Long-term treasuries basically flat. We're still waiting on data to tell us to whether or not we think the Federal Reserve is going to cut rates this month. So a lot of different things going on there. And the moderate index, which is a combination 60-40 type allocation, 60% stocks, 40% bonds, was up almost 0.5%. Then I'll give you my disclosure that I'm required to share with you. Please read that carefully. There will be a quiz at the end of today's program. Volatility. December is typically, and in November is too, a period of time where we see falling volatility. So the VIX index, which is the volatility index of the S&P, typically goes down in the month of December. We'll wait and see. We've got a lot of important data that's coming out mid-month. And also, we've got several important meetings that are taking place. Let's jump right into that. Here's the Fed update. The Federal Reserve meets December 10th. So that's next week from when we're having this broadcast. The committee is still split on a decision of whether or not they should keep lowering interest rates. And the reason is there's conflicting data. There's not a clear path that says we need to continue to cut rates in order to stimulate the economy, in order to stimulate hiring. I'm going to go through a few of those things today so you can kind of see the mixture of data that we have. Most data that we have right now is from September. So we've got 2.5 months of data that are missing and won't be released until after the Federal Reserve meets December the 10th. There's a lot of politics still at play. There's been a few names floated as a potential successor for Jerome Powell. That happens in May. In fact, there was an article in the Wall Street Journal just yesterday floating a particular person. We think that's kind of odd, but it could, for that soon, for them to be doing that. But it could mean that the White House is trying to do some testing, so they've leaked a name or two to see how the public responds. There's this whole debate here about the 2% target. That's always been the Fed mandate, to keep employment stable and inflation in check. Right now, we're running around 3% annualized inflation, and there's a lot of talk out there about that might be the new norm. We want higher inflation, or the Federal Reserve and Congress may want higher inflation. There's a lot of pros and cons to that. I'm not going to get into that in this program, but what you'll see is that a lot of people believe, and I mentioned this on last month's podcast, a lot of people believe that higher inflation is a way to pay down our federal debt in a cheaper fashion. The only problem is, that's just one of 4 ways that you can lower debt. The only problem is we know Congress will continue to increase spending over time. There's no solution truly to resolving the federal debt, I call it a crisis, for resolving the federal debt crisis until Congress decides they're going to actually spend less. It's a common thing that you and I do with our household budgets every month, is we have to spend less than we earn. If we spend more than we bring in, we're going to go into debt. Congress hasn't still figured that out, even though they've had plenty of opportunity to try to do so. So like I said, next month, or this next week actually, the Fed will be meeting on December 10th. I would expect that we'll see some rate cuts. I think there's enough other data that we'll talk about that's going to prompt them to do that. The only problem is if the Federal Reserve cuts rates too deeply and too fast, you can overstimulate the economy, and then you also have less wiggle room should you really have a real emergency. I'm thinking that the Fed's going to be cautious, but they will probably cut rates here next week. So this is the Treasury yield curve. We've always talked about the nice hockey stick curve is what you want to see. That it's still improving. You're still seeing short-term rates below the long-term rates on the right-hand side over there. And so that's still improving. I think that's something that is healthy for the bond market. The consumer price index, we haven't had any CPI data or inflation data since the September reading, and that was just released in early November. The inflation that month went up 0.3%. That was within expectations. That's about a 3% annualized rate of inflation. We will be getting the October and November data for inflation on December the 18th. A lot of data is going to be released from the government. It's going to be released on December the 18th, just in time for Christmas. We do have data on the producer price index. That's for September as well. It was up about the same. This is on the producer side. Energy did spike up quite a bit. Food was up, but the core producer price index was only up at 0.1%, excuse me. And that is the lowest year-over-year pace that we've seen in over a year. Excuse me. So in December, we'll see if those rates get cut again. Employment, this is where it's kind of slow. The last jobs report we have is for September. And it looks solid, but newer October and November jobless claims shows that there's some early signs of slowing in the labor market. Initial claims have been, these are people filing for unemployment. Initial claims have been steady around 220,000, but continuing claims, these are people that have long-term unemployment. Continuing claims have risen, and are up about 50,000 since before the shutdown. Now, whether that was from the shutdown or somewhere else, we'll have to wait to see on that and dive a little deeper when we get new data in mid-December. Now, a lot of this is reflected in the case of the immigration enforcement. We're seeing native-born employment rising, foreign-born employment declining. That's a statement. That's a comment. That's not an opinion on anything. I know there's a lot of different opinions on whether we should be deporting people that are not here legally, but I'm just reporting the data here. Now, what's interesting is that there are private data sources that do release data, and ADP is one of those. ADP Research, they weren't shut down, so they continue to release data, and so their estimates came out here just a day or two ago, and they're showing that the rate of job loss has been steady for the last 6 months. So we're seeing that, especially companies with 50 or fewer employees, which makes up the bulk of employees in the country, companies with fewer than 50 employees shed over $120,000 since May, 20,000 jobs, excuse me. And so those are things we're watching about. But ADP and the government reports, sometimes they match, sometimes they don't. We'll just have to see when it comes out here December 18th. International trade, this is even older. I'm not going to bother reporting on this data from August. We don't even have September data. Retail sales in September, now that we finally got that. Retail sales slowed in September. The expectation was an increase of 0.4%. It was actually 0.2%. But still, that was capping a pretty significant and solid quarter for retail gains. And so the weakness that was in the report there for the third quarter came from non-store retailers. And that's probably just from a pullback after all the back-to-school spending and stuff like that. So a lot of different data here. How do you interpret this? Well, there's not a whole lot we can interpret with this. The most important things you can do is you can talk to your advisor about how to navigate the economy and review your long-term financial plan. Don't react to news. There's so much. I mean, I see it every day in the markets. There's a headline. Some Federal Reserve president gave a speech and said he was not really happy about not cutting rates, and the markets take off. And there's the next day somebody else says they want to keep rates where they are, and the market goes down. Markets are reacting to headlines. You should be reacting to, how does this impact my long-term financial plan? If you don't have one, you need to talk to an advisor. If you don't have an advisor, please feel free to give us a shout. I think a lot of people are going to be surprised when they see their year-end 401k statements. 401k statements, especially the target date funds or the life cycle funds, are not performing as well as the rest of the market. Are you owning the right things? We have resources available to you that we can help you with that, but you may want to make sure that you are looking at your 401k balances. And once again, you can always give us a call, 254-282-0495. With that, folks, I said it's going to be a short presentation today, and it is for the lack of data. But if you want a consultation, that's complimentary. We can talk to you about your situation, your goals, and help you determine if what you're doing now is going to keep you on track to reach those financial goals. Folks, you've been listening to the Clear Vista Financial Perspectives monthly market update. Thank you for joining us. We'll talk to you in January, and Merry Christmas.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.